2020 was a wake-up call to many investors. It's easy to forget how volatile markets can be after over a decade of more or less consistent growth. But all good things must come to an end, and that's what happened to the decade-long bull market last year. Now, as I'm recording this, we're just about to close out 2020, and the markets have recovered from the downturns earlier this year, but since I'm releasing videos in this series roughly once a month, I'm not sure what the state of things will be once this video is edited and uploaded. So it got me thinking, should things take a turn for the worse between now and then, is there an investing strategy that is specifically designed to outperform in the moments following a downturn? In other words, is there an approach that is specifically trying to maximize its resiliency as opposed to minimizing its volatility, or even maximizing its long-term average growth figures as we've seen many other strategies do already in this series? Well, as it turns out, there is. And it's the strategy we're going to be discussing today. Let's talk about the comeback portfolio. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The comeback portfolio was created by Paul Merriman, the same guy who came up with the Merriman Ultimate Buy and Hold portfolio that we covered previously in this series. It has you split your investments up evenly between 4 different assets: a large cap value and a large cap blended fund. Merriman again recommends a simple S&P 500 index fund for the large cap blended fund, and a small cap value and small cap blended fund. The goal of this strategy, as I stated before, is to maximize resiliency, meaning that if it does its job well, it should produce larger returns following the point where the markets bottom out and, ideally, go on to set new all-time highs quicker than other strategies. It may not have the best long-term returns, and it may crash more severely than other strategies, but that's okay as long as it recovers quickly. Because a strategy that could do that would definitely have a lot of value in its niche, even if it didn't end up being the portfolio you held all the time. With that being said, let's see if the comeback portfolio manages to achieve its primary goal. As usual, we'll be starting by analyzing its historical long-term returns. To analyze the returns, we'll be looking at a few different metrics. We'll be looking at the long-term 40-year inflation-adjusted returns for every year starting from 1927 through the end of 2019, since that's still the first and last years for which I have complete data on all the assets involved in this strategy at the time of this recording. And we'll also be taking a look at how many times the portfolio lost money and how severe those losses were. Finally, we'll touch on how dependable or trustworthy the strategy is by examining how sensitive those long-term returns are to when you decide to start investing. So based on the data that I have since 1927, the average 40-year inflation-adjusted return for the comeback portfolio is about 8% per year. Its worst-case return was around 5.1% per year, assuming you began investing in 1969, and its best-case scenario was an average return of around 10.6% per year, assuming you began investing in 1933. That suggests that a $10,000 investment would grow to, on average, around $217,200 over the course of 40 years after adjusting for inflation. At worst, you're looking at a nest egg of around $73,100, and at best, $562,600. Next, let's take a look at some volatility metrics. The average standard deviation of returns for the comeback strategy was 19.5%, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 11.5% and 27.5% with this strategy. And just like with any of these strategies, there will occasionally be a few exceptions where the returns fall outside of our expected range, for better or worse. In this case, about 66% of our returns fall within our expected range. There was a total of 32 years out of a possible 93 where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 34%. And while most of those downturns were recovered from relatively quickly, there were some notable exceptions. The first was that the inflationary period of the 1970s became a bit more of a sore spot for this strategy, with 4 of the 5 10-year periods that ended between 1975 and 1979 failing to keep pace with inflation. On the bright side, the 2000s were not as bad as one might have thought, given that this is an all-stock portfolio. The 10-year stretch that ended in 2009 did fail to keep pace with inflation, falling behind it by an average of 0.4% per year, but the rest of the periods that ended that decade were at least 4.7% per year above inflation. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a great way to get an idea of how dependable or trustworthy an investment's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperforming decade and the largest overperforming decade, as low as possible. The comeback portfolio had a total start date sensitivity of 30.2% during this time frame. The largest overperformance was 15.7%, which took place from 1975 to 1985. In those years, the comeback strategy had an inflation-adjusted return of 12.7% per year, beating out the returns from 1965 to 75 of negative 3% per year. The largest underperforming decade was negative 14.5% per year, when the returns from 1968 to 78 failed to match the returns produced from 1958 to 1968. But that just about wraps up our analysis of the strategy's returns. Now let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at a few different metrics when analyzing the crashes. They are how deep the crash got at its worst, how quickly the strategy typically recovered from said crashes to reach new highs, and the Ulcer Index, which largely combines the other two metrics into a single number. Unsurprisingly, given the large amount of stocks in this portfolio with very little there to balance them out, the deepest crash was the Great Depression. From the highs set in 1929, the comeback portfolio fell by a little over 62% by 1932. It rose by about 3.6% in 1933 and then by an almost unbelievable 75.4% in 1934. By 1936, the strategy had broken through to new all-time highs. However, the Great Depression wasn't the longest downturn. That honor would go to, unsurprisingly, the crashes of the 1970s, at least when we're adjusting for inflation. By 1975, the portfolio was down over 54% from the highs set in 1969. And it wouldn't set new highs again until 1981. However, similar to what we saw following the market bottom during the Great Depression, the comeback strategy did produce solid returns shortly after bottoming out. In 1976, it grew by an inflation-adjusted 37%, and in 1977, it rose by another 31%. So while the 11-year cycle is a lot longer than I would have wanted to see, it did at least bounce back with some strong returns immediately following the market bottom. But to determine whether that is enough to truly classify it as the king of resiliency, we'll have to compare it to the results of the other strategies, which we'll do later on in this video. For now, let's wrap up the crash analysis. The Ulcer Index during this time period rose to as high as 3.6 during the 1940s. On average, it hovered around 1.2. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the comeback strategy would have maintained minimum safe withdrawal rates of 3.81% over any 30-year stretch, 3.71% over any 40-year stretch, and 3.63% over any 50-year stretch from 1927 through 2019. The worst year to retire using this strategy was 1929 for obvious reasons. I should note that as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 8.41%, 7.44%, and 6.87% for the 30, 40, and 50-year scenarios respectively, and the maximum rates for the same durations was 13.04% set in 1943, 12.27% set in 1933, and 11.99% also set in 1943. The strategy would have maintained a minimum perpetual withdrawal rate of 3.56%, and as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original principal all the way through to the end of the dataset, even after adjusting for inflation. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming that we save 15% of our income, we're planning for a 30-year retirement, and our expenses changed in line with inflation as measured by the CPI, we would have reached financial independence in 31 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 52 years. The fastest was 31 years starting in 1931, and the slowest was 64 years starting in 1950, 1954, or 1956. With a 30% savings rate, a hypothetical investor would have reached financial independence in 62 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 34 years. The fastest was 20 years, starting in 1948 or 49, and the slowest was 50 years, starting in 1964. With a 50% savings rate, a hypothetical investor would have reached financial independence in 77 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 20 years. The fastest was just 10 years, starting in 1927, and the slowest was 34 years, starting in 1959. And finally, with an absolutely crazy 70% savings rate, the numbers improve still further, with a hypothetical investor reaching financial independence in 86 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 10 years. The fastest was just 5 years, starting in 1931 or 32, and the slowest was 21 years, starting in 1963. So in the end, what we see is a strategy that produces very strong long-term returns, but quite a bit of short-term volatility, which is to be expected from something that's completely made up of stocks. Due to that volatility, the returns it produces tend to be a little more luck-based than something like the classic 60-40 strategy, which is illustrated by the comparatively higher start date sensitivity, though it is at least better than a straight-out S&P 500 strategy in this regard. Again, that's totally expected for an all-stock portfolio. But to wrap up this video, I really wanted to take a closer look at how resilient the comeback portfolio actually was relative to many of the other strategies that we've covered so far in this series. In order to figure that out, I've picked out a few different metrics that I feel will give us a respectable picture of how resilient a strategy is. The first, of course, is the strategy's average and maximum comeback durations, because measuring how long it takes for a strategy to go from bottoming out to setting a new all-time highs is an incredibly important consideration when looking at resiliency. For this metric, I included all downturns, not just the ones that ended up leading to a fall of 20% or more. The second is the typical comeback magnitude, because while coming back from a downturn quickly is impressive, it can be even more impressive if the size of that comeback was larger. I'd rather be invested in something that grew by 30% for 2 years to set an all-time high than something that grew by 5% for 1 year and set a new all-time high, if you get my drift. The third consideration is the amount of time that the strategy spent in either correction or crash territory, defined here as being at least 10% or 20% below previous all-time highs respectively. Because if a strategy is constantly hovering 15, 20, or 25% below previous all-time highs, even if it isn't in free fall at the time, it probably isn't being the most resilient. On your screen now, you'll see how the comeback portfolio stacks up to other strategies we've covered so far in this series in these metrics, since 1976 anyway. I had to use 1976 because most of the strategies we've covered didn't have data going all the way back to 1927. So this was the earliest year I could use that had data for all of them. In terms of average comeback duration, it takes about 1.1 years to reach new all-time highs after bottoming out. This is on par with the classic 60-40 strategy, but slightly behind an S&P 500 strategy. It's also a fair bit behind the standouts in this metric like the Golden Butterfly, Larry portfolio, and even an all-cash approach, which all had recovery times of less than a year. In terms of the longest comeback duration, the comeback portfolio pulled ahead of the S&P 500 with a max duration of 4 years. However, once again, it was trailing the standouts in the category by a noticeable margin, as both the Golden Butterfly and Larry portfolio had maximum comeback durations of 1 year during this time frame. As far as the magnitude of the comeback goes, the comeback portfolio places fourth, trailing only the Merriman Ultimate portfolio, an S&P 500 approach, and an all-cash approach. Finally, in terms of time spent in either correction or crash territory goes, the comeback portfolio seems to perform very similar to the no-brainer strategy. It spent 11% of its time in correction territory and 7% of its time in crash territory. This is worlds better than the S&P 500, which spent 34% and 18% of its time in those same situations. But it's also noticeably behind strategies like the Golden Butterfly and Permanent portfolios, both of which spent a mere 2% of their time, or just 1 out of the 44 years in this dataset, in correction territory. They were never in crash territory. So in the end, does the comeback strategy accomplish its goals? Well, that's a bit tricky. At least based on the data that I have available to me, I'm not sure I would classify it as the most resilient strategy out there. Its maximum comeback duration and its time spent in either correction or crash territory are just too far behind the true leaders in this category for me to give it the nod. But we did see that it does tend to produce solid returns following major market downturns. I mean, 75% inflation-adjusted growth following the bottom of the Great Depression is very impressive. And unfortunately, due to the limitations of the data we have available to us going that far back in time, it was not something that I could examine when comparing it to the other strategies in the previous section. Additionally, the comeback portfolio does seem to perform a bit better than the S&P 500 in terms of overall resiliency, and particularly when it comes to how quickly the comebacks tend to start, illustrated by it spending far less time in either correction or crash territory. The same could be said if we compared it to a total stock market fund. So if you're looking for an all-stock strategy because you want the long-term returns that it historically provides, but you want to make sure that you make the most following hard times when they come, this is probably a step forward from a simple all S&P 500 strategy. But if you also value things like tranquility, consistency, or dependability of returns, there's probably other strategies out there that are also a little more resilient in most cases, even if the long-term returns are a bit lower. But what do you think? Am I underrating the comeback portfolio in terms of its resiliency? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.